Good evening, members. I welcome you all to this study circle meeting on corporate social responsibility and the interplay with accounting standards and auditors' responsibility. To dwell on this subject, we have CA Vikram Udupi sir. Can I request CA Raghuram to escort the speaker onto the dais and then welcome him with a floral bouquet. Thank you, sir. Thank you. I have privilege in introducing today's speaker, CA Vikram Udupi. Vikram Udupi is a fellow member of Chartered Accountancy. He is a licentiate ICSI. Udupi Vikram is a partner in Suresh & Co., a firm of Chartered Accountants with more than 52 years of experience. With a passion for newer and challenging opportunities, he is instrumental in firms' foray into consulting and advisory services in Ind AS, US GAAP, IFRS, reporting, financial controls review, due diligence, and etc. His specific presentations include: he has been part of ICAI for preparation of education material for Ind AS related matters, a regular speaker at ICAI on topics which include Ind AS, accounting standards, standards on audit, professional ethics, etc. His area of specialization includes statutory audit, Ind AS, IFRS, US GAAP, reporting and consultancy on financial reporting, internal financial control reviews. With this brief introduction, I present before you CA Vikram Udupi. Over to you.
Thanks a lot, Mr. Rajana, for this introduction. Thanks for ICA for giving me this opportunity to be part of this study circle and being present at this evening. So thanks to you all for coming over in the evening to be part of this whole session. So let me give a brief background as to why the whole corporate social responsibility has come into picture. We all know business as such, the objective of business is to make profits or to grow the society or to be part of the growth stories. Any entity which makes profit, on one hand they are using the resources from the, I would say, the earth, and there has to be some obligations from such entities to do something good for back, I would say, kind of return activities towards the society or the mother nature for giving them a kind of place to run the operations. So keeping that in mind, the whole corporate social responsibility has come into picture. Even before CSR came into its life, there were quite a few companies which were following CSR on their own. Many of us would have heard our parents talking about Mr. Ratan Tata or Jamshedji Tata did so many things for their places, or various other people, Birlas have done specific things for their places, etc. That has been there throughout. If you read the background of Infosys or if you read the background of Wipro's family, each of them do their activities more than their obligation. But there was a requirement to bring this particular clause, and why section 135, Companies Act 2013, when it came into picture, through 135 CSR was made, rather enacted through statute. And those people who would have seen Companies Act 2013 coming into picture, they would have understood the importance of CSR, or rather the kind of importance given to CSR. Section 135 was one of the first sections to be announced, which was made effective. There were quite a few sections which were not effective, but section 135 was put in place. The whole objective there was, this section is something which is very vital and companies should start following it. And with that objective, it was clearly made. Section 135 was there, and also the rules had been enacted at that point in time, and section came into prominence. So the agenda for today will be discussing on what exactly the CSR provision speaks about. If you read the law, on one hand we have Companies Act which is there, on the other hand we have rules. There is a specific rule which speaks about corporate social responsibility. We have to be aware of the rules, we should be aware of the act, which is section 135. Plus, in addition to this, our institute has come up with quite a few articles. You have a technical guide on CSR. There is also a guidance note on CSR, and the major breakthrough for this section 135 happened sometime in 2020-21, while the circular 14/2021, which was issued on August 25, 2021, the circular came up with a beautiful frequently asked questions. So these frequently asked questions helps both the practitioner and the company to follow CSR in a proper way. So these are all the provisions or guidelines which you should be aware of before you get into understanding what is there in the section. Now in today's agenda, we will understand what does section 135 talk about. 135 is a section which gives reference to the provisions related around corporate social responsibility. First, we will understand who does it apply to, then how much has to be spent, which is more of quantitative things, for what causes can CSR be made, which is the objective behind having a provision, what are the modes through which the amount can be spent, and finally, as all our accounting goes, how does it get reported. So these are all the broad factors, I would say the segments in which this provision or section 135 has been designed. Then we will get into the finer aspects. Basically, it will have certain practical matters, maybe something about frequently asked questions or something which we would have come across during our practice. We will try to understand certain specific concerns through finer aspects. We will try to cover applicability of CSR, the framework, expenditure, the activities, and so on. So that will be the agenda for the day. So how it all started? CSR, basically the backbone or the person behind this, it was through the Chatterjee model. CSR was there across globe. It was in Europe, it was more on the reporting model. It was about what kind of reporting has to happen. Today, if you see, there are quite a few additional reportings. The way Companies Act or SEBI works in India is, first there could be one regulation which will come in Europe or in the United States, then it gets applicable to India. And this you can see across various provisions. For example, the way internal financial control came into India. Initially it came as Sarbanes-Oxley in the United States, then it was more or less replicated to India through IFC. If you have to see on the LODR aspects, the kind of LODR which happens, again it's a kind of replications which happens. We learn from there. All our standards on audit are more or from the ISCS. Followed by, if you see CSR also, the story remains the same. Or today we are talking about certain ESG reporting. We also talk about the strategic activities which a company does. It is already mandatory in Europe. In India, these are all recommendatory. So those who are getting into practice or those who are looking at improving the practice, they need to concentrate on what is mandatory outside, which is getting recommendatory here. And in future, obviously, that becomes mandatory. So the Chatterjee model allowed or gave the background as to how should CSR be implemented in India. And when it was made, it was very clear to say this reporting is not only about the disclosure, the reporting will be on the expenditure which is made. Everywhere if you go through the CSR regulation, they are using the word spent. Even the section starts with the word amount spent. So it's more on the money which you are spending than on any other stuff. Initially the whole stuff was started through public sectors. Subsequently, White Companies Act, they brought it for all the companies which are registered. On overall section 135, there are around 9 subsections. It's a very simple section and it speaks about various other provisions which will come there. In a brief, which I need to, if I have to tell about what is there in those between 1 and 9 subsections, a very interesting way in which section 135 is drafted. If you read section 135, the section 135 subsection 1, it does not say whom the section applies or rather how much they should spend. Section 135.1 actually tells if a company falls in any of the bracket. There are 3 brackets. One is on net worth, then it is on turnover, then it is on profit. If the brackets are complied, it is mandatory to have a CSR committee. If you read all other sections, it is, even though it says it is on the spend, they directly get into the provision, but here section 135 is an exceptional case where it says if these 3 conditions are followed, it is mandatory for you to have a committee. Section 135.1. 2 is again an authorization for the board. If committee has to be done, then board has to say who is part of the committee. That is there in section 2, subsection 2 rather. 3, what the committee has to come up with. Committee has to come up with a policy, CSR policy, that is told in subsection 3. 4, again it comes back to the board, where board has to confirm the CSR policy. I will be going in detail on these policies in the subsequent slides, but I am just trying to give a nutshell as to how it works. Subsection 5 tells how much should the CSR be, the quantity what I was talking about, the 2% norm comes in 5. 6 speaks about what if you have not spent 2%, maybe either underspent or overspent. 7 is a section which is very important, this is on the penalty. 8 is more about the authority of central government, and 9, the last subsection, there it says as per subsection 1, if you fall in the category you need to have a CSR committee. 9 says you don't have to have a CSR committee provided the expenditure which you need to incur is less than 50 lakh rupees a year. So 9 is an exception, subsection 9 is a proviso or an exception to subsection 1. So in simple, these are the only things which are there, but the way it has become important is the disclosure forms matters a lot. Disclosure wise, if you see, schedule 3 has a specific disclosure for one of the sections in Companies Act. So if you read schedule 3, there is a specific disclosure. If you read CARO 2020, there is a specific comment which has to be done. So there are various reporting which happens around CSR, and that's why the importance is higher both on the accountant side and on the auditor side. So this is what I was telling, 135.1. If the net worth is more than equal to rupees 500 crore, or turnover is more than or equal to rupees 1000 crore, or the net profit is more than or equal to 5 crore in the immediately preceding financial year or previous year. If any of these conditions are complied, then it is mandatory to have a committee. So something which is worth noting here, always we have been understood the way a rule or any other guidelines work. First comes the act, then comes the rule. Rule is more of a guidelines to say how a section to be read or how a section to be applied. Companies Act 2013 came up with lot of rules, rather the act gave lot of additional authorities for rules. majority of the sections, or rather I would say chapters in the Act has rules of its own, and any amendment could be easier if at all you have given the authority for someone other than Act. So that's where the rule comes into picture. And here if you read, there are cases where it looks like rules has got additional powers than Act. So is it something which is allowed? That is where I am trying to, you need to have some thought of analysis here. Can rules override Act? If you read, for example, 135(4)(a), and these are the sections where there is a reference to rule. Under 4, they say the policy in its report needs to be placed on company's website. Any company which has where the committee is applicable or a CSR is applicable, they need to have their disclosure on the website. The authority to how to disclose has been given into the rules. Again, for subsection 5, there is a reference to the rule. And 6, basically on the ongoing project, which I will be discussing more in the subsequent slides, there is a reference to the rules. If you read majority of the cases, there is a reference to the rule. So section needs to be read together with rule, unless and if you miss out that, understanding the entire section could be little challenging. Now let us get into the brief, rather detailed understanding of subsections in section 135. Under 135.3, I was telling you, the moment there is a CSR committee has to come up with their policy. So what is that they are supposed to do under section 135.3? One, they have to formulate and recommend to the board on the policy, how the policy looks and how the policy works. Policy shall indicate the activities to be undertaken as per Schedule 7. I am just mentioning Schedule 7. Schedule 7 is again part of Companies Act 2013. Schedule 7 gives reference to for what activities can a company spend money on CSR. There are around 12 different sections under Schedule 7, wherein it explains the different modalities in which you can spend money. Then CSR committee should also recommend the amount of expenditure, how much money should be spent on CSR, and most important, it is the responsibility of committee to design a policy in which the entire CSR activities gets monitored. As we have been seeing in various other activities, the most important thing, execution, planning is one of the most important things, and finally the monitoring is another important stuff. So it is the responsibility of committee to make sure the entire policy has been appropriately executed. Followed by section 135.3, wherein the board is required to act upon certain provisions. One, it is the responsibility of board to make sure 2% of the average net profits have been spent on CSR activities, and a provision for this is if at all a company has not completed 3 years, if it is less than 3 years, we will have to take as how many ever years that it has completed. How and all can CSR be done by the company? There are 3 different modes in which CSR can be done. One, it can do through activities, various activities which are given in Schedule 7. It may be about eradication of poverty, it may be about slum development, it may be about education, it may be about gender equality. These are all the different activities which have been prescribed in Schedule 7. So a company can either on its own or through the support of another corporate can perform these activities on their own. That is one option which is available. Second option, a very simple option which they have given, if you are not able to perform these activities on own, you may, like how we give donation to anybody, you can donate to a specific fund. These specific funds have also been defined in Schedule 7, which includes our Prime Minister Welfare Fund and PM Care Fund. The third one, which is taking a lot of, I would say, which is becoming more important nowadays, people are trying to spend money on that, is contribution to incubators or any R&D projects. So what exactly these incubators are? Incubators is basically, it's a community or it's a place where any new activities or new things gets simulated or it gets incubated. For example, we all know, we call Bangalore as Silicon City of India. Why it is called? Because there is a Silicon City in the United States which actually incubated the whole IT field. So whatever is done out of silicon, it got incubated there. When we say incubation, so basically what's happening is like-minded people are coming together, they are working together for the common cause. Today we see artificial intelligence, and one of the major drivers for artificial intelligence, as we all know, is the owner of Tesla. He was the one who started that incubation whole process. Like this, you have, for example, our own Bangalore's STPI is an incubation for IT related stuff. So people who are into software exports, they all come together in that place and they will get to know the benefits which are available. And something more about this happens in institutions like IITs, IIMs or IISs, where the common minded people come together and they work on their goal, and those are called incubation centers. The more you spend money on these incubation centers, they'll be able to come up with new technology, with a new business model and various other things through which the country can grow. Keeping that in mind, this incubation center and R&D projects were brought into picture. This also, if you see, there are, for example, Audi spends lot of money on incubation. Today you might have heard Audi has created an Audi Foundation where they are supporting the group of people who are working on non-fossil fuel resources, maybe various other things. As we all know, petrol is something which can go vanish. So Audi has to look at coming up with a new model, and that's where they spend money. Their CSR activities or their donation could be to those kind of incubation centers which are working on certain things which are important for the future of country. And that is where people start investing more, and incubation centers are getting more benefited out of this particular provision. There is a penalty subsection in this section 135 itself, in addition to the general penalty which is there in the Companies Act. The penalty is basically for non-compliance with subsection 5 and subsection 6. Subsection 5 is that you need to spend 2%. Subsection 6 is, if at all you have not spent, how should you treat? So on the company side, the penalty is pretty high, which can be as big as twice the amount which had to be spent, or rupees 1 crore, whichever is lower. And there is also a penalty on the officers who are in default. For them, it can be up to 1/10 of the amount of the CSR, or rupees 2 lakh, whichever is lower. So it is there on both the people. Initially, when section 135 was enacted, the non-compliance were there were not much notices which were issued. From last 2 years, whoever is part of companies which are liable for CSR, they would have got to know there are quite a few notices which are being flowing. The kind of notices which are coming, I will be again discussing in future. In one of the regular rules, what it says, CSR does not mean that you spend money for your own benefit. Means, to take an example, assuming there is a company which is into paint, that company should not get into the CSR activities which indirectly will support the paint industry or the employees in the paint industry. So what it says, it should not be for the welfare of your own employees, or it should not be a marketing activity for your organization. You have to do something beyond. It has to be for the welfare of the entire community and not specific to an individual group or into individual industry. And there are quite a few notices which have been sent for companies which are actually indirectly supporting their own employees or their own product. And that is where knowing this particular section and reading the FAQs helps. And for such kind of companies also, penalty has been levied. Implementation, how can we understood, we just got an idea as to how much we have to spend 2%. To spend 2%, we should have a policy. The policy has to be done by the CSR committee and board has to approve all these things. Now, how can the execution happen? How can the implementation happen? We also read there is an option. The simplest option is donate to the fund which is specified in schedule to the Companies Act. Not that all the companies will be interested in funding this. The reason is very simple. 2% of their net profit is a good amount. Just to give an understanding how the number looks, the top 5 companies which are doing CSR in India, altogether the top one is obviously Reliance, which is spending around 700 crore, followed by HDFC, more or less same, around 700 crore. The third one is TCS, again they are also spending around 700 crores. Fourth and fifth is ONGC and Infosys, they spend around 400 crores. Imagine this much of spending which is happening. If they just donate it to one fund, nobody understands what they have done. And actually, if they spend on their own, if they can create some projects, the kind of impact what they can have on the society is much higher. So majority of the cases companies would like to do on their own. That is also allowed in our CSR procedures. The third one which is again allowed is if company does not have that much of capabilities. It's not that all the companies are like Infosys where they have Infosys Foundation. A few companies will be managing on their own but they may be making good profits. They are allowed to give as a donation for any trust, registered trust or a Section 8 company. But whenever you give this money, as per the requirements of committee, they need to design how much money we will give, how the money should be used and for which activities the money should be used, by when the money should be utilized. So these principles, these policies will be part of the CSR documentation, and through the third party, in the language of CSR, they are called implementation agencies. Implementation agencies, as I said, could be a trust or a Section 8 company or sometimes societies also. They can get it done from those 3 kind of people. Now, here also there were a couple of challenges. In the last year, few notices were seen. What the question which MCA or ROC is trying to seek is, you have given fund to someone, but what is the assurity that user, rather we call it as donor, an implementation agency, have they used it for the purposes for which you have given? There are certain notices which has gone. So it is a responsibility of a company to make sure not only that they spend money, not only that they create policy, they should also get involved in the execution process. You should get an update as to where are you spending money, what are the purposes for which the money has been sent, and whether it is properly monitored. Unless you have all this documentation, it may not be possible for you to substantiate when there are notices. And why it is so important? It's a big number which is getting invested. There are various ways fraud can happen. There are various ways suckling of money can happen. To avoid all those, these provisions are pretty much strict, and looking also at the kind of money which you are talking about. The top 5 companies contribute almost 3,000 crore rupees. If that is not used properly, the objective of the section is not met. The objective of section is not just to make someone spend money. The objective is to create a change, to bring a change in the society. There are few things which are excluded, which cannot be considered in the investment, in the CSR policy when someone drafts a policy. Before that, I just missed out one thing. So this is one of the CSR policies. I have taken it from Infosys. It's one of the beautiful documents which generally I follow whenever we have to read something. This is how a CSR policy look. Majority of the companies will not have a complete CSR documentation when we go for reviewing that. So it is always better to follow which is what is available in the domain. Maybe you can follow the Infosys policy. It's beautifully done. So it gives details about what is the context in which it is done, what are the objectives which they are looking at. Here it says what are the areas the Infosys is looking at for their CSR activities. One, hunger poverty, which is part of Schedule 7, education, part of Schedule 7, rural development, part of Schedule 7, gender equality, environmental sustainability, national heritage. These are all the different areas which they have decided for that particular period. They have brought it in their policy. And how do you implement it? That also they have explained. In hunger poverty, how are they going to implement? What is their strategy? They have explained everything for each of the activities. And how the undertaking, how will they undertake? How they manage the ongoing projects, and who is responsible for managing all this, everything has been explained, and they also give the reference to the Infosys Foundation. If you see the way CSR happens in Infosys, there will be hundreds of requests CSR Infosys Foundation gets on a regular basis. Based on that, they will do their analysis, and a summary of that or some brief of that will be submitted to Infosys CSR committee. Then Infosys CSR committee decides what they can do. That's how it's called a backward integration, where CSR Foundation is very much near to the society. They know the challenges. From there, the data comes to the Foundation's committee. From the Foundation committee, it goes to the CSR committee, which gets identified and gets approved in the board of Infosys. It's a beautiful strategy what they have, and they are able to achieve their objectives in a better fashion. Finally, even before actually the rule 8 basically of CSR rules came into picture, Infosys was doing the impact assessment. Today, impact assessment is mandatory for certain class of companies, wide rules. So when I say impact assessment, that's the most important thing. Many people, we get to see many people donating. Even we would have donated today. Recently there was a crime mishap which happened. Many people have started donating. The whole question here is, whatever is donated, is it being used for the purposes for which we donated? Is there any positive thing which is happening because of the CSR activities? That needs to be assessed, and it is done by a specified professionals who are experts in that. They do this analysis. A very simple example, assuming Infosys is spending money on women empowerment. So what kind of women empowerment has happened? What kind of people they are supporting? What was the scenario of those people 2 years back? And after donation, what is the scenario today? If 2 years back also they were same and today also they are same, the impact assessment makes no sense. And through this, someone will understand actually the things are changing or not. And Infosys started doing this pretty much before. Now it is part of the law as such. They are also talking about the composition of CSR committee, which is again required as per the section. If you read an annual report, rather director's report or annual report, you need to speak about the committee, the members in the committee, and what kind of meetings they, how many meetings they had, and how many meetings people have attended. So all these details are part of their policy. Now excluded activities, which back to the section. Few things as I mentioned, if an activity, if the donation or the CSR activity is something directly or indirectly related to the business objectives, then no, this will not be allowed as per section 135. If an activity is taken outside, conducted outside India, then that money whatever you have spent cannot be part of your 2% bracket where you need to compute. Third one, any donation to political party does not fall within the definition. Any specific activities which benefits only the employees of the company, which cannot be part of our 2% criteria. Sponsorship activities for deriving marketing benefits. An example for this could be, say, a real estate company doing some sponsorship on real estate related activities. Maybe like, it could be about educating the people as to how to construct, or a kind of promotional events to support constructors by getting a different technology. So these kind of things cannot be part of their CSR because they belong to that particular industry. And the only exception here is if the sponsorship is supporting Indian sports people, then it is allowed. That is the exception. If any of the provision is required under the law, that cannot form part of CSR as such. These are all the excluded activities. Now, effective 2021, the new concept ongoing activities came into picture. There was a requirement, there was a need for this. Imagine a company like Reliance or an Infosys which spends so much of money. They may be spending money on a project wherein the project is a big one, where the time taken to create the project is something more than 12 months. So how it will be identified, how you will make sure that the compliance is still part of section 135. That's where ongoing thing came into picture. They said ongoing is that particular activity where the time spent is generally relatively more than 12 months and goes for a couple of years. And they defined in this way, they brought this into the act. They defined what is ongoing activity, and they restricted an ongoing activity cannot take more than 3 years. It's not that I keep on telling I am working on a particular project. There has to be an upper cap of 3 years plus the financial year in which you started. So you have to make sure there is a plan and there is a completion date, and you have to spend the money. Whenever an ongoing activity is happening, the requirement under Schedule 3 also changes. As I mentioned, in Schedule 3 there is a disclosure where we talk about how much money had to be spent and how much money is spent. There we make a separate disclosure on ongoing activity, how much was projected, how much is done, how much is pending. Imagine after 3 years you are not able to complete the project, then it is mandatory for you immediately to transfer the balance funds to the specified fund in Schedule 7. So specified fund, we just explained all those PM care funds and all those, it has to be transferred immediately. And few of the things on ongoing activity from the board side, first they need to decide what these ongoing activities are, how much money to be spent, when it has to be spent, and most important, monitoring of the implementation, and last one, making any modifications. So this, because of from this we will also understand you are allowed to make modifications. Many companies went through this during 2020 and 2021. Lot of companies started keeping aside some funds for COVID related activities. But by the time year got over, COVID was much in the control and there was no requirement for you to spend money. So what happens at that point in time? So that's where this particular thing was brought in. Board can modify the initial objective with proper explanations. Initially I wanted to do ABCD, but during the course I realized this does not have any impact or does not require any spending, so we can amend the amend whatever was actually planned. Few things which needs to be thought about. Imagine a company has already undertaken CSR activity for which a liability has been incurred by entering into a contractual obligation. The vendor has completed the obligation and has raised the invoice on the company. However, the invoice stands unpaid. It's a case where company has employed an increment vendor has worked, it was a CSR activity, vendor has performed the obligation, but the money is not paid as on 31st March. Then how the treatment should happen? In my books, I would have created a liability but I have not completed. Will it still amount to compliance with CSR? Or a similar one, the company has appointed an implementation agency implementation agency has completed its obligation. However, the payment has not been made to the implementation agency. The first one was vendor, second one is implementation agency. Third one, company has entered into a contractual arrangement with a vendor. Vendor has not completed the project. However, company has transferred the money to the vendor. Should this be considered as a CSR compliance? So how should we treat it? So there are certain differences. One of the particular provisions which speaks about this, it's not that you just spend the money, you should also make sure the activities should have happened. So gaining the inference from there, it is required that if you have just made the payment to a vendor, that does not mean you have complied with the CSR activities. That vendor should have completed his obligations. And only when you receive the confirmation that the vendor has completed, then you can tell, yes, the CSR obligation have been met with. Otherwise, no. The first two things more goes on the judgment. If the objective is met, in the first two things objectives are being met, there is an activity which is done but the liability is created in the books but not spent, you will create an expenditure in the P&L and you would have created a liability in the balance sheet. It can still be considered as compliance under section 135. In how should we, I also mentioned 135 subsection 6 speaks about the unspent or overspent activities. When until 2020-21 there was no concept of unspent funds or overspent funds. If a company has spent the money, they had to disclose. If a company has not spent the money, board had to give a report explaining why they could not complete the activities and what things went wrong. And there were quite a few directors' report which were just explaining for ABCD reasons we were not able to comply with CSR. And later on in 2020-21, the amendment happened in the law where they brought this particular provision of unspent. They said, fine, you have not spent during the year, good, but still you have to make good for whatever bad it has happened. Assuming as on 31st March you did not spend the money, but you have a thought process to spend on ABCD activities. Then that becomes an ongoing activity, and if at all you have designed an ongoing activity, the law gives you 30 days, 1 month from the end of the financial year. Within that 1 month, you have to transfer the money to a separate bank account. It's a special account. It's called as unspent CSR account. It has to be shown separately in the books. There is a specific disclosure given in Schedule 3 under cash and bank balance. Even though money is not transferred, assuming companies which signed before 30th April, money might not have been transferred. It's an obligation on the company to disclose wherever they are doing ongoing, to disclose this amount separately in the cash and bank as unspent. On the other hand, you do not have a thought process on the ongoing, but you fail to spend money. Then they have given 6 months of time. In that 6 months gap after 31st March, you can you can move the funds to a specified fund, in the sense donate to a specified fund. The only option allowed if you fail to do by 31st March is to transfer to specified funds. You have 6 months for that. How do you disclose those? Again, there is a separate thing I will explain about that. And as an auditor, we need to comment on these two things. It is not just the company. As an auditor, clause 20 of CARO 2020, we need to comment whether the company has complied with this. That again I will discuss in the later slides. How should we treat those scenarios where money has not been spent prior to 2021? Will our 2020-21 amendment will be applicable for those cases? The answer is no as such. It is only prospective. Board can decide how they want to spend. If they want to use 2020-21 unspent model, they are allowed. Otherwise, they can do however they had planned. This is the disclosure which I was talking about. if wherever you have spent money on CSR, it has to be shown separately in the P&L, statement of P&L. And amongst the money which is spent, if there are multiple activities, just now I showed you Infosys had multiple activities. If each of those activities are material, then company may decide to show each activity separately. Otherwise, single line disclosure is fine. Amount unspent, again it will come into P&L. There has to be a liability which has to be created. It will come to P&L, and you may create a liability in the balance sheet. We also, one thing which we need to understand, when there is, on one hand I said there is an unspent money, on the other hand there could be a scenario where you are supposed to spend 2% but you have spent 3%. What can happen to that 1%? Prior to 2021 there was no explanation for this, but from 2021 such money the company may decide to adjust it in the subsequent years. The way it works is, in 1 year he has spent 3% because of during COVID the company would have been more conscious in supporting certain social things. They would have spent 3% or 4%. That delta of balance, which is either 2% or 1%, they can carry in their balance sheet under loans and advances as excess money spent, and in subsequent years they can use it. But the only clause, only restriction here is, if you have spent excess money, you have to use within next 3 years. If you fail to use in next 3 years, 4th year you will not be able to adjust it. There could be a challenge, in 1 year you are liable for CSR, subsequently 3 years you weren't liable for CSR, then irrespective of that, the excess amount gets expired. So you need to write it off from the balance sheet. So if you see any balance sheet where they have shown as excess money spent, it is actually an advance, it is a part of balance sheet and they are eligible to carry that. On the other hand, unspent money, as I explained, it will sit either under current liabilities. It will sit in current liability if it is a case other than the ongoing fund. If it is an ongoing project, you will show it under cash and bank but with a separate disclosure. Impact assessment. It is one of the most important activities and also the recent amendments. It is not liable for, it's not that all the companies has to do impact assessment. Impact assessment doesn't come cheap, it's pretty much costlier. The people who have to do this analysis, they charge a good money. So there is a bracket which is given. All those companies continuously who have spent more than 10 crore on CSR obligations and who have spent more than 1 crore on a project, they are liable to get CSR impact study done. And one additional condition given here is the CSR impact study to be done on the project which has completed at least 1 year of existence. As on 31st March you completed CSR, on April 1st you cannot do a CSR impact study. If you have completed an activity by January 2023, you can do CSR impact study only after February 2024. So you have to give that 12 months bracket. And there is also a restriction on the money which you can spend on getting this CSR impact study done. They are told 50 lakh rupees is the bracket or 2% of the amount spending what you are doing. So there is a restriction on that also. This is how Infosys CSR committee ka report looks. Wherever CSR committee is there, your director's report or your annual report should have the details. So if you read here, this is extracted from annual report of Infosys, where they have mentioned there are 3 directors and one amongst them will be definitely an independent director. They have spoken about what is their CSR philosophy. They have spoken about objectives and responsibilities of the committee, and they have also spoken about what are the charters which are governing their committees. Of course, the first and foremost is section 135, which gives the guidance as to how it has to be done, and they have a committee charter of their own. Whenever they have a committee charter of their own, it is mandatory that they disclose the committee charter If you go to the annual report, you will also get to know an index where, or rather a link where you can go and check what is the committee charter talking about. And also they have mentioned how many meetings they had and how many meetings were attended by how many people. So it's 100% attendance what they had. They have also given the explanation of specific things. Then here I mentioned the committee policy and charter they have disclosed in their annual report, and they have also given the CSR report. If you read the CSR report, they tell what is that they have spent on, what are all the ongoing activities, and specifically in one of the exclusions which I have told, if you have spent money outside India, you are not eligible to show it as 2% bracket. If you read Infosys, it mentions they have spent money outside, but whatever they have spent outside is over and above what their obligation was. So it's not that they have restricted, they have spent their 2% India plus they have also done outside. And this is how the disclosure happens. It's again I have taken it from Infosys annual report. This is the requirement as per schedule 3, and there are around 8 disclosures which has to happen. One, amount required to be spent by the company during the year. How do I arrive at the amount which has to be spent? Go back to section 198. 198 tells what are all the items which you need to consider in profits, what are the items which you can exclude in profits. That's the starting point. On that 2% you have to spend. Amount of expenditure incurred is how much have they actually incurred. What is the shortfall at the end of the year? What was the shortfall from the previous years? What are all the reasons for the shortfalls? What kind of activities have they done? And the most important thing which has been brought in the schedule 3 last year was, if at all there are any transactions with related parties which has an impact on CSR, which is related to CSR, you have to disclose over there. If you have created any provision regarding the contractual obligation, you have to disclose those. So to go by this, Infosys tells they are liable for 437 crore, they have spent 392 crores. There was a shortfall of 45 crores. The reason for shortfall was this pertain to ongoing activity. So if it is ongoing activity, they have 3 years time period. And nature of activities, it was more on the COVID-19, healthcare, promoting gender equality, whatever we saw in the policy. How much they have spent through related parties? Of course, it will be one of the related parties is a major agency. They have spent around 321 crores. No provision per se they have created. These are the mandatory disclosures. Disclosure of NIL, which is nil or not applicable, is also a disclosure. The company has to make all these disclosures in their financial statements. Now comes, so with this we have understood the provisions of the law, the responsibilities from the auditor's side. What activities an auditor has to do when he goes for audit? One, the moment company tells I have done section 135 compliance, first thing which you need to see is all their activities, is it as per schedule 7? If any activity is done beyond schedule 7, that will not be allowed. First you need to draw that checklist and you need to say yes, this is part of schedule 7, so it is allowed. Then the separate disclosure of expenditure, just now we discussed schedule 3 disclosure. There has to be a work paper which gives the workings for each of the disclosure which is made, and you need to also check whether the expenditure has been done in line with the CSR rules. The company, we should also consider applicable accounting standards. Accounting standards speaks about various, whether it is previously there was a scenario where you could have spent money on capital asset, today it is not allowed. The moment you have a capital asset, if at all you have spent, you have to hand it over to the donee for whom you have built it. That compliance with accounts, especially on the recognition, has to be taken care. Then there are 2 standards on auditing which is very important, which is vital whenever we do the audits. One, the consideration of loss. We need to have the documentation with us to say we have complied with SA 250, other loss, SA 720 relating to other information. We just showed you all other information, so you are obligated to comment on those informations also. As an auditor, your work paper should have explanation or documentation to substantiate audit procedures are done and audit procedures are in line with the standards which has been prescribed. The broad framework could be: one, you should have broad approved CSR policy. It is required to have the minutes of meeting and the agenda of the board or the CSR team. Workings on amount to be spent under section 135, very important. What comes in net profit, what does not come in net profit needs to be computed, rather reviewed. Bank statement analysis is again an important item. When there is a specified bank account, in the last one of the last slides I said, if the company has not spent the complete money on an ongoing project, they should keep aside the money into a separate bank account. That bank account analysis has to be done in 100%. From that bank account, they cannot spend any money other than CSR activities. That needs to be reviewed. Disclosures made by the management and unspent amount review is again part of the auditors. Now, how can our audit plan or audit procedures be done? One, the program needs to be created. Our audit program has to be available. Procedures, each of the procedures what we have done needs to be properly documented. If section 135 is not applicable, why it is not applicable should also be documented. It has to be taken on records by the auditor. There are few companies which also brings in their financial statements, they mention why section 135 is not applicable. Even that's a good methodology. The management's note on the CSR should be available with us. What is that management which is doing? What is their thought process? That should be available with us. Implementing agencies and implementing CSR activities, how they are implementing and what is the purview within which they are doing, all those things needs to be documented. Additional importance should be given for related party transactions. Complaints with the CSR activity by committee needs to be reviewed. Wherever possible, try to visit the locations and take the evidences to substantiate activities have happened. These are all part of the audit procedures. Here we come to the one of the last clauses where in CARO there is a specific note, there is a specific comment rather on CSR. This is again an amendment which came in through 2020 order. There are two disclosures which has to be done, 20A and 20B. 20A is more on it's on two things, on the ongoing project and on the regular projects. If it is an ongoing project, what disclosure has to happen? If it is a regular project, what disclosure has to happen? In simple terms, they are trying to bring the numbers into picture. If you see, if it is an ongoing project, how much money was identified to be spent and for which year it was identified to be spent, and out of that how much is unspent. Column C is basically the percentage of column B, and how much of that has been transferred to a special account. Since it is ongoing, you have to transfer to a special account, and when did you transfer, rather when were you supposed to transfer and when did you transfer and what was the delay. Now here the question may come, 31st March is the due date for the, rather 31st March date is the cutoff date for the balance sheet. As an auditor, you have to go beyond 31st March. If at all we are signing it before April, the comment may be there is 30 days, they have time to transfer the funds. You can mention in the paragraph. If 30 days is done, you will have to mention when they actually transferred. Again, it follows to two more, another wing. They were supposed to transfer and they have not transferred. There comes another table. They were supposed to transfer say 1 crore. They have transferred only 80 lakh. Balance 20 is not transferred. That will also come in your CARO report. The similar disclosure happens when it is other than ongoing project. Everything is same except that in the ongoing project we have to transfer to a special account. Here it is to a specified fund. In ongoing, the time period allowed is only 30 days. Here it is 6 months. So generally in this disclosure, there may be a scenario, if the money is not transferred, you will say they have the time till so and so date and they have the they are planning to transfer, if at all they have to confirm you. That note can come in the auditor's report. If it is already transferred, you can disclose the same. From the implementing agency, again many of the times as auditors we may be appointed or we may be given an assignment to comment on the implementing agency's compliance. As an auditor of the main company, it is required for auditor of the main company to seek the utilization certificate from the donee. As an auditor of the donee company, you need to do your own procedures. There are guidance notes which tells how should you do audit of expenses. There are guidance notes and standards which tells how should you draft your audit report, or rather your review report when you are not doing the audit but you are giving your report on the utilization. There are multiple standards, so you should follow those and you have to give your report. Now the last part of the session, there are few questions which we tried consolidating here based on whatever we have learnt now. And this is also something which we come across in our profession. Many times the companies will come up with certain questions, or many times as auditors we come across certain doubts. So those we tried consolidating here. First one, whether CSR provision applied to a company that has not completed the period of 3 years. Answer, it is applicable. Even if it is 2 years, we have to do it based on the 2 years. Unless this is a first year company. A company which is in the year of incorporation, they are not liable for. Otherwise, the moment any of the 3 conditions are complied, and if they are there for 2 years, they have to comply with the CSR. Can CSR committee delegate responsibilities to subcommittees? Yes, this is allowed, but board has to approve this. Whether provisions are CSR applicable to section 8 company. This is a peculiar thing. What is section 8 company? We also read section 8 company can be an implementation agency. And what does section 8 companies do? They are section 8 companies by nature are those entities which are not performing for the profit, not for profit companies. There is nothing called profit. When there is no profit, are they still required to comply with section 135? So, is it yes or is it no? If you go in detail, this is something where the analysis has to be done. Unfortunately, the way section reads, all the companies, the word says all companies. So because of that, even though section 8 company is not a for-profit entity, still they become liable for CSR. So just because section 8 companies are there, you cannot mention that you are not liable. Please take a note. All section 8 companies should follow CSR percentages. How is average net profit computed? Of course, it is profit before taxes, section 198. Whether holding or subsidiary of a company fulfilling the criteria of 135 has to comply with 135, even if holding or subsidiary itself does not fulfill the criteria, means there is a holding company, there is a subsidiary company. Subsidiary company is liable for 135, holding company is not liable for 135. Should I still follow section 135 because one of the companies is liable? Answer is a clear cut no. It is specific to each company. For whichever company is applicable, they should just follow. They are not their related parties. Another important thing which comes up in CSR, administration overheads. There is a provision which tells you cannot spend in excess of some percentage as administrative overheads. So what exactly these administrative overheads are? As an auditor, it's one of the biggest challenge whenever we do the audit. How do you identify what is admin and what is technical? Rather, I would say not technical, but more of project oriented. Very simple example which will come to us is, imagine the finance team or accounts team of a company. Is their salary admin or non-admin? The simple way to understand or rather decide could be, the way you can judge is, to what extent the accountant is required in execution of CSR activities. Imagine CSR activity required some sort of compliance or some sort of funding, and without accountant you are not able to do that. because he is the one who has the capacity to go and get the transactions done, a complaints which had to be done. So those things, in such scenarios, accountant's cost can be admin. Imagine you have spent money on I would say medical related stuff. You have spent good money for taking the doctors from Bangalore to a rural place. You have spent good money on transportation. In this case, transportation is actually for project, it is not admin. You are spending money because that was required for you to take people to that place, and they are there. The doctors are the ones who are doing the CSR activities. So it can be considered as project related and not as admin. So these are the judgments which we need to do whenever we pose with these kind of challenges. Whether contribution in kind can be monetized to be shown as CSR? Answer is no. The word used, as I told, it is spent, so it has to be spent in monetary value. Are admin overheads applicable for expenses incurred by the company, or can they be applied expenses incurred by implementing agency as well? If implementing agencies incur any admin charges, as a donor company I cannot consider that. So it should be only my admin charges and not considering there. So whenever you get a UC and they say they have spent X percentage on their overheads, assuming total spent is 100, they have spent overheads of 4. So in your reporting, how much is spent on the CSR is only 96 and not 100. What is the meaning of surplus? There is one more thing, surplus in CSR activities. You have kept some funds for CSR activities and that money has earned interest. That interest should also be used for CSR activities. You have done some activities for CSR that had earned you some income out of that. That again should also be spent on the CSR activities. So examples, maybe there can be various examples, assuming you are working on, rather you are doing some activities of environment protection. You have done some planting related things that has earned you some income. That income should be respent on the CSR activities. Whether contribution to the corpus of an entity is an admissible CSR. Previously it was admissible, effective 2021 you cannot. If you are giving any money to corpus, it cannot be allowed. There were quite a few amendments which happened. In the trust also there were quite a few amendments last year in the Finance Act regarding corpus. So these are all interconnected. If a company spends more than the required amount as per 135, we explained, we can carry it forward for next 3 years. Whether it is mandatory for companies to carry out CSR in their local areas, it is it's like, you know, it's advised to do the CSR activities in the local areas. In today's world where things are happening through I would say the cloud or in different manner, it may be challenging for you to identify where exactly the company belongs. So wherever physical existence is there, it is advisable to do from the local areas. Is it mandatory for every implementing agency to register in MCA 21? Yes, MCA 21 is a portal which is there in, rather it's a domain, MCA domain manages this MCA 21 portal. There all the implementing agencies, whoever takes funds, CSR funds, they need to get registered. Without that they cannot do it. Whether all 3 types of entities, whether it is section 8 or trust or society, are they required to be registered under income tax? Yes, it is mandatory. Can an international organization act as an implementing agency? No, it has to be only the Indian. Yeah.
So this implementing agency registration with the MCA portal, whether it is applicable for the trust also receives the...
Yes, yes.
Okay.
There is an option to do. There is an option.
Private limited, I mean,
Section 8 or
trust, it has to be
yes,
registered.
yes. It's a simple thing. It's like, you know, you giving your name to the MCA telling boss, you can refer my name to others. So the moment they go to the portal, the donors will get to know these are all the implementing agencies, and it makes their life easier to find them. So what is the maximum permissible time? We explained it is 3 plus 1, including the financial in which it was started. Can ongoing projects be implemented through implementing agencies? yes, it is allowed, but there will be lot of compliance required. CSR committee has to come with a proper policy, and the implementing agency should comply with the entire CSR policy of the donor company. And as an auditor, it will be an additional compliance for review for you to do. As a company, they need to have all the documentation. Can funds earmarked for one project be used for another project? Yes, allowed, provided the board has approved it and there is a proper disclosure. Whether disposal of funds by a company to the implementing agency for the implementation of project will be considered as spent under section 135. I just explained in one of my earlier things. Just giving the money does not confirm that you have complied. There is a good saying in the recent days. As a son, it is not, your duty is not just to give money to your parents, you should take care of your parents. So similar principle, it's more of ethics or it's a more of social values. You should conduct and then spend. It is not just that I paid some money to someone, I do not know what is happening. So if you see majority of the companies, they, wherever CSR happens, the company goes to their place, they see it and they get executed. Even many times I have seen companies, their expenditure may be sometimes more than the CSR fund, but still they do it because that's where they feel they are part of it and they see that there is an impact which is happening. Should a company open separate unspent CSR account for each financial year? Yes, like how we have those unpaid dividend account, in a similar fashion we need to have separate unspent CSR amount. Yeah.
That account should be a current account or it can be transferred to the FD also?
It's, see, actually it is not answered in this, but if you read the way RBI speaks, they say the account, they use the word deposit. Deposit is savings or current or FD, anything. So from that, in my personal view, it can be anything. But the only thing is, if you have kept it FD, that interest also you should use it for CSR. That's the only thing. Is expenditure on impact assessment over and above administration overhead of 5% or included in the same? Now this 5% got amended. There they say there are certain things. Now impact assessment, if I have spent, it will be in addition to that. It will be from my pocket which I will incur, but there is a restriction of 50 lakh. I cannot spend more than 50 lakh on the impact assessment. Whether reporting of CSR is mandated in the board's report? Yes. I just showed you how Infosys has reported. That's a mandatory requirement. So this is all about the CSR. So we covered the section 135, we covered rules, the FAQs, and Schedule 7 you can read out. A good quantum of Schedule 7 was there in Infosys report. More or less that is the maximum thing which any person can do. So this is all about CSR. Few important things to be kept in mind: the way 2% is computed, the way CSR policy is implemented, the way CSR policy gets monitored, how the amount gets disclosed in the financial statements, and as an auditor, how you comment on the CARO 2020 report. One last thing here which I missed explaining. These expenditures are not allowed as a business expenditure when you file the income tax return. So whenever you compute the profit, please make sure this expenditure is added back and the profit is increased to that extent. On that you have to pay the taxes. Again, there were certain questions: why should it not be considered as business activities? Income tax has its own thought process on that. So as things stands, it is not allowed. Again, there is a couple of views. If the money is spent by you, obviously it goes through the Schedule 7. That is an expenditure which cannot be claimed as a deduction. Assuming you have transferred to a specified fund, which can be a Prime Minister Relief Fund or a PM Care Fund, can you claim deduction under 80, the donation whatever you have in income tax? There are both views. Few people say it is allowed and few say it is not allowed. Maybe decision has to be taken based on the judgment and the analysis over there. So any question I can take?
Sir, just can you explain of the capital asset? You said कि now it is not allowed for the capital. Suppose the companies are preparing a grounds for this course and they have purchased the land, they have developed the stadium or facilities for this course.
Correct.
So now who will have the ownership?
They have
of
to
it?
transfer it to the.
No, means there is no one is there. It's because the company has opened it, purchased a ground and they develop it for the general public.
Correct.
For activities.
Correct.
And it is free of cost.
Correct.
They are providing the services to free of cost. The
Yes.
land is in the name of the company. So now how should we do?
So generally what happens, few companies what they did, there are examples, not about the land, they had built a school kind of like, a place where people can be taught. So that was in their name. They transferred it to another trust which is managing that, and the trust is the owner. In your example, there can be a scenario, the company can create a trust of its own and it can transfer to the trust.
But if the company keep the same land in their name, what will be the impact?
If you read CSR, it is not allowed.
No, means the land, they can have the land building, maybe the depreciation, they won't be able to claim the depreciation.
That is a secondary part.
But expenditures, they are every year they are spending on the
Maintenance.
What is the need of creating that trust? I don't understand this.
The objective there is, if an asset is in the name of the company, if today or tomorrow, there can be a scenario, it is not available for the general utility or the general public requirement. Tomorrow if someone comes, say there is a change in the management, they come and tell boss, those days they have done it. Today I don't want, I want to start some commercial operation in this place. They can still do that because they are the owners of it. They can change, a new management can decide whatever they want. So that can be done. For you to say it was a CSR activity, it is mandatory that you should not own it. That is the thought process. But how do you execute is again something which is practical, which has to be taken into context.
So you are saying it should not be in the name of same entity. Some other entity has to be.
Some other entity has to be your either Section 8 or a trust. Because then implementing it will come, because for you either you have to spend on your own or you need to have another agency which is eligible to do. So it has to be that only.
It's not the business profit
Yes,
organization.
it
It
cannot.
should be a part of non-profit organization.
Yes, yes.
And sir, what's the ongoing projects when you just say the ongoing projects? There is a time limit of you said 30 days.
To transfer the funds.
Fund to transfer. And suppose if you, what is the consequences of not transferring the fund to within the time limit?
My section 135 7 will come into picture, which there is a penalty.
Penal consequences.
Yes, penal
consequences.
Yes, yes. But it is not a criminal offence, it's more of a civil offence. Like, there were quite a few amendments which are.
Financial liability.
Maybe I told there is a requirement.
Penalty
So,
officers will be-
yes, that can come into picture.
So, this and second thing is that after a special account you said, after 3 years if you are not using for the same thing, it will be transferred to the special account.
Shall be transferred.
Shall be transferred.
To a specified fund.
And if you don't do that, then
Again this 135 7. Yeah. 7 will come. Always any 5 and 6 non-compliance. 5 is about the spending, 6 is unspent or overspent. Any non-compliance that falls into 7, which is the penal clause.
means that can be the seizure of the account also.
Pardon?
Seizure of the bank account also, that can be the CSR amount.
No, here it is only about the financial obligation. They have said penalty is equal to so and so amount. As such, if you read Companies Act, there is no seizure, it comes in income tax. So you may go into general clause also. That may come in, it's on case to case. Today all these notices are on case to case, you have to go and establish your case, and if your case is something which can be accepted, who knows, they may accept and you don't have to pay.
Because any of this expenditure is not allowed in the income tax, and anything, whatever it is left, it is only the part of the formalities of the compliances which you have to, otherwise you may have to pay the penal amount to that.
Yes. Today what also happens is, majority of these companies will have independent directors. So that will come into picture, and of course whoever is making that much profit, they will be forced to make sure there is a compliance. This will have multiple iterations.
And who is executing this compliance from
The data is going on, I showed you those disclosures, right? Those are part of Schedule 3. And through Schedule 3 it goes to the annual report, your AOC and all. And there is a repository of data available with MCA.
No, it's ROC only can.
Yes, ROC only. You will get only from ROC. All notices are from ROCs. And you know, it goes to an extent, assuming you want to even liquidate the company. These compliances has to be made good first. Otherwise you cannot.
Sir, for any company, Section 135 is applicable. No, one company, Section 135 is applicable. But they do not have the liquidity because of accumulation of the debtors. Okay, in such case, out of the borrowed funds, they utilize for the CSR activity.
Yes.
Whether the income tax people will object because out of
There
the
may-
borrowed funds,
there-
you are spent
there
for
may be, sir.
CSR.
There can
Because
be.
the interest partially will not allow.
There can be,
Proportionately
sir.
will not allow.
Definitely, you have a section, Section 37 says if it is not for business, the objective is not for business. So why
Yeah.
should I allow? That may be possible.
This is an obligation created by the central government only.
Agree, but still, the primary word under income tax is not a business activity.
But liquidity is not there, then what to do? How they can fulfill the condition?
Again, sir, if you read section in income tax, there is no direct answer. But substance over form, it is not for business.
As an auditor, should I proportionately
I would suggest,
dissolve that?
I would suggest yes.
interest?
I would suggest yes. If at all it is directly, see there are multiple things.
Yes.
If it is a overdraft, if there is a, obviously you cannot take a term loan to pay this.
overdraft.
It has to be overdraft only. Some quantification needs to be done.
Yeah.
So generally what companies, how generally they do is they do on their basis, they will wait for someone to question. At that time they will take it forward.
Yeah, that's right. At the same time, administrative expenditure will be there. Accounting staff, engineers, whatever it is, technical people. But the salaries also proportionately that will dissolve because they are spending for
No,
implementation.
that one, that's what it
CSR
specifically
activity.
says.
Yeah.
That one specifically says you need not to go to that extent.
Yeah.
It is the only 2%. What they are disallowing is 2% of the profit. You are not allocating your salary to CSR activities. What we are telling is this much salary is anyway there. That's part of your expenditure. If you are computing this much of salary, say for example accountant, his salary is 1 lakh rupees.
Yeah.
You are allocating 20,000 of his salary to CSR, assuming you are doing that.
Yeah.
Then the 20,000 get disallowed because it is part of your 2%.
Yeah.
It will, that entire amount,
That too
it will
have
get
to-
reclassified from employee cost to CSR expenditure. That gets disallowed.
So rural development, it's technical people, they engage engineers and all, company engineers itself. Their salaries, how to
No,
proportionally-
that technical guy, whatever you are spending, is it part of 2% or general activities?
General activity, salaries will be paid.
Hmm,
That will come to the profit and loss account,
Correct.
expenditure of the company.
correct.
Say the company is using for implementation of the CSR activity also,
Hmm.
rural development, education, whatever it is. In that scenario, as an
And-
auditor, how I can
No,
estimate
see,
what will be
the
done?
way it happens here is, I am obligated to spend 2% on the CSR.
That's okay.
Okay, in the 2%, are you considering this technical guy's salary? It is you are accounting. The whole thing here is accounting. If at all you are considered his salary also in the 2%, then it becomes your CSR.
I am not considering that one.
Then it will not.
I am worried
then,
about the income tax.
Then prima facie, it should not be disallowed. Prima facie, it should
Income
not be
tax
disallowed.
also, they will not tax.
Prima facie, it should not be disallowed. Because I am not specifically using him for CSR activities.
Yeah.
He is doing his I am paying salary to him
Yeah.
for the job description what I have given him.
Yeah.
In addition to that, I am using him for my CSR activities.
Okay.
That's an additional responsibility for which I cannot assign how much is the cost.
Yeah.
So it gets up.
In that area, conveyance is involved, so many things are
Sir,
involved.
again, that conveyance, if it is part of your CSR expenditure, it gets disallowed. If the-
That's what.
So that's why wherever you disclose, If you are disclosing it as a separate line as CSR, without any doubt you will get disallowed. That's the one.
Due date within 30 days or 6 months for implement. Whether it is from a accounting year end or
Accounting year end, the financial year end of the company.
it is from approval at the AGM.
Sorry?
Accounts has to be approved at the AGM.
No, 31st March 2023. From there 30 days. 31st March 2023. From there 6 months. That's how it works. If your year ending is December, then 30 days from there.
By the time profit will not be finalized.
It is 2% of last year profit, no? That you will know on the day one itself. That
The
you will know.
shortfall can be made up in the current accounting year. Means
Sorry?
If there is a shortfall in the expenditures, you can make up it in the current
You will
year.
definitely, yeah, you can make up
And if
it.
there is a excess also, you can carry forward it.
Yes, you can.
So in a drop of 3-5 years, it should be the same, means according to
But 135(7) will still be applicable to you.
I'm saying means instead of considering as a 1 year, you can see as a block of years.
You can, but you will not be excluded from 135(7).
Means every year you have to comply with the 2% of 198 profit of every
Yes,
3 years.
yes, yes.
And every year you will have to just, but you can have in mind that if you are complying over the period of 3 years as a block of year, you are complying with the provision.
No. As per the section, no. In the disclosure itself, you will say,
You will have to report in the audit report.
Yes.
But so far the penal consequences will not be there because if you are complying with the 3rd years.
135(7) is still applicable, no? The penalty clause. It does not stop because you have made the payment. Your primary responsibility, primary non-compliance with subsection 5 still exists. 135(7) still comes. Maybe
You
the
have to
weightage
justify.
could be lesser.
I mean, if you justify that the amount could not be spent because of certain reasons and it is an ongoing project, it will be spent in the next year, then it's
It all
other.
depends on that person. If he accepts, you are fine. Yes, sir.
How to identify the specified funds? You mentioned unspent CSR.
That is there in Schedule 7.
They will give a specified fund.
They have given.
They have
PM Care Fund and various other Prime Minister Relief Fund, all those things are there.
Sir, everyone will only donate the fund to the ATGs, means as per the income tax, any fund or any care fund where you are getting the benefit of both CSR activity and the tax deduction also.
One of the views is, that's what I told, no? There are two views. One set of people say I should be eligible for donation. Other set say, sorry, you are not eligible. It is not a clear-cut thing.
So that is why the company, instead of spending through their own account,
Hmm.
they will always prefer to go to some fund. which
Those
are
those
eligible
who
for
do
ATG.
not those who do not have that appetite. See, it all depends. No, when see it's like this. If I am spending a good money, why should I put it someone else's name? It has to be in my name. That's when you have
Create
done
their
that, you
own
will feel
trust.
that.
They can create their own trust, they can get
Yes.
their certification.
Yes,
also
need
for
not be
deduction.
own trust. They can do it from other trust also, but their name comes. See, the kind of thing you feel at the end of the day, you feel I have done something. If you are given to, with due respect to the funds, without commenting on the funds, that becomes part of one huge corpus. You will not know where it went. You will not even be able to see the fruits of your effort. 2% is your
But
effort.
even if you can create your own fund also, and you can be eligible for the both deduction and the income tax and also.
No, that is not allowed.
No, means company.
No, and the income tax it is not allowed. How will you claim? It's not a business expenditure, no?
Trust is there.
Huh?
Trust you have created it first.
It means company has created a
Charitable
trust.
trust.
Huh.
I am saying about the charitable trust. You have created a charitable trust and you are eligible for IT deduction in the charitable trust.
Yeah, the trust per se.
Under the income
Trust
tax.
per se.
Under
Yes.
section 11.
Yes.
Now, because you are the writer of the trust, company's promoter are the writer of the trust.
Manager. There is no writer. It's a manager of the trust.
Means,
Trustee.
trustee. Now in your company, you are transferring the fund to that trust. You are
Correct.
getting the deduction.
No, you are not getting.
Why?
It's not a business expenditure as per income tax.
No, if that trust is eligible to issue with the deduction.
Whatever it is, CSR expenditure
Even you are giving the donation also no.
not allowed.
So accounting it as a CSR.
Yes.
But here it is you said you can donate the fund to.
I can donate. I have three options. Either I can donate to those specified funds, or I can get it done through implementation agencies. The word used is implementation agency. It can be a trust or a section 8. I can do it through them as first I give them a donation and I tell them, boss, you use this for ABCD purposes. It's a donation only. In his books, he will show it as donation receipt and he will claim it as expenditure and he will not pay any taxes. But for me, it's a CSR expenditure.
Whether it is in a whatever kind of
Yes.
is not eligible as a deduction purpose.
Sir, 31st March 23 we are auditing now. See, 2% of the profit, average profit, we had to go back to 20, 21, 22,
Last 3 years.
last 3 years,
Yes.
immediate last 3 years.
Yes.
That one only we had to consider whether
Yes.
that amount was spent or not.
Yes. Yes.
This year.
Yes. On first day of April only, you would have got to know that.
Yes.
That you will know.
So this financial year we need not worry about how much it will come.
We need not do it.
Earlier 2 years or 3 years,
Yes, sir.
whichever applicable.
Yes.
So drawing to the reference to this gentleman's bill, suppose I am donating to a specified fund, assume PM care. I will add back my expenditure
Yes.
and I will claim a deduction on section 18. That is allowed, no?
No, that is what I am telling you. There are two views.
Ah.
One view tells, yes, it can be claimed. But the primary thing says this, there are two ways. Under 80G, what does it say? Any donation paid is allowed. That's a primary thing. But here, there is one more section which tells any CSR expenditure is not a business expenditure.
Yes, sir. I will add back that expenditure. Assume I am not donating to a.
That is one view. I
trust
am
which is
telling you that is one view. There are people who are doing this.
I am paying to a PM care fund,
Correct.
specified fund.
Correct.
So,
But how did you disclose it in P&L?
P&L, I mean, I will, anyhow I will add back.
How did you disclose in P&L? Adding back is separate. How do you disclose?
P&L, I will disclose it as a CSR fund only.
That is the view. It says it is a liability which has come to you because of a particular provision which is under Companies Act, and that provision you are doing good use it by paying to a PM care fund. So primary obligation was CSR. So that way you cannot claim it. That is one of the views. But there is another view which tells, boss, I don't care. It is allowed.
Sir,
There are two views.
Sir, one thing I will business expenses which are added, which is not considered as a business expense.
Yes.
In the income tax, when you add back the expenses which are not the business expenses, deductions, exemptions, and expenditures. Three are the three sections of the income tax, which cannot be interlinked. Means one expenses is there, which you are adding back. Deduction is some different thing. Exemptions are different, and expenses are different. So if you are adding back the expenses on the account that these are the not business expenditures, but it doesn't take you the right that you cannot claim as a deduction.
No, how will you claim? It's not deduction. It's donation you are taking.
Deduction.
See, there again the thing is, it was not a business expenditure. The primary focus.
Otherwise, not. Otherwise, if you have been allowed as a business expense, there was no need to claim the deductions.
No, but that's how the law is, no?
But no rulings are there so far.
There are. That's what I'm telling. There are two ways. There are rulings, there are case laws which says sorry, it is not allowed.
And not in favor of it.
It seems there are in favor also. I'm not gone to that extent.
Earlier,
Because I wanted to claim, but sometime I kept quiet. Let us not get into that.
earlier GST input was allowed. Now in this budget specifically they say it's not
Correct.
allowed.
They removed that also.
Like
they
that
removed.
in income tax also 80G they have to define.
Yes.
Assume, sir, the company has donated a CSR fund to a trust. The trust, the project will be carried on across the India, assume 20 places.
Across the?
India.
Okay.
Healthcare.
Okay.
Assume across the India 20 places. In that 20 places also there are multiple sub-projects. How will management go and verify whether that disclosure is required? Like these 20 places, we are implementing the healthcare project and it's been given to this X trust as one. How auditors should know that the project is going in these places and it's been monitored. Example, considering it's an ongoing project,
Yeah,
runs
yeah.
for 3 years.
See, the primary thing is your CSR charter. What is defined in the CSR charter? Does it allow you for all the places? If it yes, what is the way in which it is being monitored? The control system there matters a lot. If you are able to monitor, say, like how, assuming that you had 20 branches. As an auditor, you would have checked the internal controls of all the 20 branches.
No,
The same way it happens for managing, rather for coordinating with 20 different branches of the trust. What kind of controls the trust has, what kind of systems the trust has, how the trust is reporting to the company, how the company is actually confirming that these are the activities which has happened, what kind of evidence the company has, that you will check as an auditor. See, end of the day, auditor, you will have limited resources, limited time.
No, I am asking from a disclosure perspective.
Disclosure, it is up to you, no, you don't have to disclose all the 20 things. Your disclosure is limited to how much money you had to spend, how much you spent, how much is balance, and for what purposes. You will say it is for the medical purpose.
So you are saying you have to get a confirmation from the trust.
Donee and the auditor of the donee.
But
And plus management's monitoring mechanism, rather CSR committee or board, whichever it is.
Coming to penalty, implementing agency is not spent, that amount is as it is. To whom it is applicable, sir?
For company only.
For
It is clearly told. No?
In every officer, only the company secretary or all the directors?
Directors.
Including directors?
Directors, and if at all you are going by committee, assuming you have a committee in your
All the members of the
company.
committee.
Yes.
So you are saying all the directors, all the members of the committee
Yes.
and the company secretary who is the officer?
CFO.
CFO also.
Provided you are CFO under the bracket game, not a designation CFO.
No, if you are CFO, so obviously you are the same.
Need not to be, no. See, CFO is specified companies need to have CFO and his name comes in the record. You can have CFO as a designation. You need not to be a CFO on the record. You need not to sign the balance sheet also. That's it. Thank you. Thanks a lot. So, thanks for the patient hearing. So, any doubts you can let us know. This presentation will be shared. You can take it from there. Okay. Thank you.
Members, just after the World Environment Day on 5th June, session on CSR vis-a-vis accounting standards and responsibility of auditor was discussed, and sir discussed also on Sarbanes-Oxley Act and then IFC and whatnot. An apt topic for the week, which was very well dwelled upon by CA Vikram Udupi sir. A round of applause for the fantastic session. On behalf of members present here and all the managing committee members of Bangalore branch of SISF-ICI, we thank you, sir, for your time and effort. The practical experience, what you carry was discussed upon, and definitely helped all the members present here. As a token of appreciation and gratitude, we would like to hand over a memento to the speaker. Can I call upon CA Bahubali, sir, to come on to dais and then do the honors. Thank you, sir. Thank you so much. I thank each member present here who have supported us in doing this session. Hope your knowledge kitty has increased. On behalf of Bangalore branch of SISF-ICI, I CA Manjunath Mahallu, Secretary of Bangalore branch, thank each one of you for supporting us. Thank you once again. And I sign off for the day. Thank you. Keep supporting us for future programs also.